Hey guys, in this video, we're going to talk about the collar option strategy. Now, this is a strategy involving a covered call and a marred or protective put. Now, what that does is it gives you protection against large swings in a stock, as far as, let's just say, a stock being bought out, some news events coming up, etc. But what it also does, it limits your potential to the upside, but it also gives you that good protection. So we're going to go ahead. We're going to place a covered call here. So we're in Apple here in our August monthlies. We're in Apple and we're going to sell this covered 150 call. So you can see we're selling this for around 122 and we're long shares right at 145.86. So what we're going to do is because we have this covered call on, what we're going to do is we're going to scroll down here and we want to purchase an out of the money put. So we're going to purchase this 140 right here. And preferably you want to purchase something that is cheaper than what you sold this call for. So we're selling this call for 122. So we're going to buy anything up to $122. So we're going to go ahead and we're going to buy this 140 put right here. And what that does is actually we receive a small credit for this. So what are we doing right now is that we are long shares at 145.86. We have a call here, out of the money call, sold at 150 for 122, and we're buying this put here at 140 for $98, or I'm sorry, $103. So this gives us a small little credit here of 19 cents. Not a whole lot, but we are just using this for protection. So this is kind of the only strategy where you don't really want to play the actual premium swings up and down, right? You're just kind of doing this all for protection. So what this does, it creates a collar around your stock position, right? So we're stock here at 154.86. And what it does, it creates a ceiling for us and it creates a floor. So I'm going to go to a different tab here so you guys can kind of see how this looks. So you can see up here, we created this ceiling at the 150. So even if Apple skyrockets past this 150, which we don't really want it to keep on going up here because we're going to lose out on potential bigger profits, but we kind of wanted to always end up right around this 150 range, basically wherever your short call is. That's where more or less where you want the stock to be at expiration. Our most that we can make is going to end up being $430. And that's because once we get up here past this 150 is that we get these shares taken away. So we cannot make more than what we're selling these shares for, and that's going to be the 150. And we're currently paying 145.86 plus we're getting a small little credit. So basically more or less max profit here of right around $430, and that's the most that we can make no matter what happens. Apple keep on cruising up here. We're not going to make any more money. Because we're going to get our shares taken away right here at the 150. On the downside, we do have protection in case Apple all of a sudden just tanks. We have a long put here at the 140s. So what's going to happen down here is that even if Apple tanks all the way down to the 130, this put is going to get exercised. And the most we're going to lose here is going to be 570 bucks. And we're going to get our shares taken away at 140, or we're going to put them in the hands of the options seller, that put option seller, right? So our biggest loss is going to be losing shares below this 140 here. And our biggest gains are going to be losing our shares up here above 150. So ideally what you want is you want the stock to kind of end up around here. You're fine if you get them taken away at 150, but you don't want the stock to run all the way up to 170 because you just capped all this profit that you just could have had, right? So that's why you don't really want to do these in very, very high IV environments where the stock price is going to be skyrocketing up and down. You want to do this in a little low IV environment. And then if you do get that sharp IV to the downside, you're protected. But if you start creeping up a little bit, obviously, then you're going to be okay with that. And you're not going to be mad at yourself when Apple goes up to 180 and you just sold all your shares at 150 and you had 100 of them at 145. So that's all a collar is. Basically just gives you a nice floor, gives you a nice ceiling here on your stock positions. It's a great way to kind of protect and hedge yourself against your longs. And again, it's really the only option strategy where you're not really playing the premiums. The only thing you're playing is you want to try to get as much credit as you can by taking this short call and using that to finance this long put here. So you don't want to have a debit of like 120 or something like that. You always want a credit. So when you do get assigned here on the floor or the ceiling, or I'm sorry, exercised or assigned, that it's not going to hurt as bad, because if you get a credit, then both of these options kind of offset. You got to kind of look at it that way. So again, that's all a collar is. You're buying an out of the money put, you're selling an out of the money call, and you have 100 shares at a certain strike price, and then your max loss is going to be to the downside, and you're not going to lose anything more than getting your shares taken away at the 140s, and then your max or your max profit to the upside is going to be you're getting your shares taken away up here at your 150 call. Okay, guys, thanks for watching. Make sure to check us out on our social media. We have attached the links to our socials in the description, and we also have a trading service if you're interested. For more information, check the description below.